Welcome to today's Explainer. We're going to absolutely dissect Shoe Station Group using pure, hard data. Is this incredibly tempting valuation hiding a massive retail trap? Picture this, a retail stock trading at a huge discount, paying a dividend, carrying literally zero debt, and insiders own a huge chunk of it. Sounds like an absolute dream, right? Well, today we're tearing down the financials of this footwear retailer, which you might actually remember as Shoe Carnival, to uncover the severe red flags and surprising green flags that mainstream media is totally ignoring. Okay, let's jump right into part one, the ultimate value trap. First things first, this microscopic 0.37 price to sales ratio instantly grabs your attention. When you see a number that low in retail, you really got to ask yourself, am I looking at a once-in-a-generation bargain, or does the market think this business is completely broken? Look, we're talking about a company with roughly 500 stores across the US, trying to pull off a massive pivot from a legacy low-end brand to a much higher margin concept. And when Mr. Market prices revenue this cheap, right in the middle of a transition, yeah, you absolutely have to look under the hood. Now, at just $15.50 a share, the surface metrics are honestly mouthwatering. You've got a price-to-earnings ratio of just 11.5. Compare that to the broader industry average, which is sitting way over 20. And the price-to-book ratio, an astonishing 0.63. That literally means you're buying the company's assets for less than they claim they're worth on the books. Throw in a free cash flow yield approaching 15% and a solid 4% dividend, and it looks like the perfect setup. But you know retail, cheap can get much, much cheaper in a heartbeat. Which brings us to part two, the red flags. Let's peel back those attractive layers. Ouch! The recent earnings implosion here is violent. What we're looking at is a nasty shift from reliable profits straight into a painful $5.6 million GAAP net loss in just the most recent quarter alone. That's a staggering 160% drop in earnings year over year. No joke. Now, management, sure, they're going to point you to their adjusted figures to, soften the blow. But as serious analysts, a GAAP loss is a GAAP loss. You just can't brush a sudden drop-off of this magnitude under the rug. So the reality is, revenue is actively shrinking. It's down 5.6% to $1.13 billion. And it gets worse. Analysts expect absolutely zero growth next year. Pair that with a 3-year earnings per share growth rate sitting at a negative 21.7%. And yeah, historical earnings are moving backward fast. These aren't just isolated hiccups, it's a compounding issue. And hey, in cutthroat retail, standing still means you're moving backward. And moving backward is usually step one toward total obsolescence. Then, we run right into a major downside risk, the Graham liquidation problem. Legendary investor Benjamin Graham loved finding net-nets, basically stocks trading below their pure liquidation value. But here, while the stock trades at $15.50, the net current asset value is a measly $3.14 per share. Think about that. If they locked the doors tomorrow and liquidated everything, Graham's math says you'd only get about $3 back for your $15 investment. That is a massive risk. And here is the absolute Buffett deal-breaker. Warren Buffett prioritizes return on invested capital above pretty much everything else, while Shoe Station's ROIC is an anemic 4.84%, while their cost of capital is over 6.5%. So what does that actually mean? It means the company is literally destroying shareholder value right now. Every single dollar they reinvest into the business is yielding a return lower than what it costs them to get that capital in the first place. Financially speaking, they are running in the exact wrong direction. To cap off all these red flags, we've got some serious strategic whiplash coming from management. First, they went all in on ditching the legacy Shoe Carnival brand to target a wealthier crowd with the Shoe Station concept. Fine. But then they abruptly slammed on the brakes and totally scaled the transition back. And now, well, suddenly they're out in the market looking for external acquisitions. Talk about mixed signals. When management doesn't have a steady, rock-solid vision, investors need to be on high alert. But hold your horses. Let's impartially pivot to part three, the green flags, because this case is incredibly fascinating. 34%. That's the massive chunk of insider ownership at Shoe Station Group. Let me tell you, that is practically unheard of for a publicly traded retailer. When the CEO and the management team have their own personal net worth tied directly to the stock price, they aren't just hired guns. They are eating their own cooking. They've even been using company cash to aggressively buy back shares during this downturn, which signals some deep, personal confidence that a recovery is coming. And backing up that insider confidence is a legitimate fortress of a balance sheet. In a retail world that's just littered with leveraged buyouts and crushing debt, Shoe Station has zero long-term debt. Zero! Plus, they're sitting on $129 million in cash and boast an interest coverage ratio of 128 times. So that immediate threat of bankruptcy that usually haunts shrinking retailers, it's basically non-existent here. They have plenty of runway to figure things out. Remember how grim that liquidation value looked earlier? Well, actually, scratch that. Let's look at the conservative Graham number, which paints a totally different picture. It comes in at a really impressive $30.19. This metric blends earnings and book value to find a super safe intrinsic value. With the current share price hovering at roughly half of that, this stock is offering an incredibly rare 50% margin of safety. Mr. Market has severely discounted these assets, giving you a huge cushion if things go sideways. Furthermore, looking through the lens of Peter Lynch, historical EBITDA actually maintained a solid 10% growth rate over the last 5 years. That gives the stock a very healthy Lynch-P ratio of 0.96. In Lynch's playbook, anything under 1 means there's room for a serious profit recovery. If their transition to the higher margin Shoe Station brand actually succeeds across their footprint, the profitability turnaround could be absolutely explosive. You're basically paying for a caterpillar and just hoping it eventually transforms into a butterfly.
Okay, let's put all this to the final test in Part 4, the Value Gauntlet.
It is wild how completely divergent the titans of investing are on this exact same data. Look at this. Benjamin Graham's raw math screams buy. The PE is under 15, PB is well under 1.5, and you have that massive margin of safety with zero debt. Perfect fit for Graham. Peter Lynch, though, he'd probably say wait. He loves that PEG ratio under 1 for sure, but the recent Q1 loss and negative 3-year growth trends would totally force him to put this on a watch list until they accelerate earnings. And Warren Buffett? His quality filter demands a hard avoid. With zero competitive moat in retail and an ROIC under 6% that's actively destroying value, Buffett would pass in a heartbeat.
Which brings us to our final conclusion in Part 5, the final verdict. At the end of the day, Shoe Station Group epitomizes what we call a deep value turnaround. This is a classic high-risk, high-reward scenario. You are stepping into a structurally challenged, shrinking business, for sure, but you're doing it with a massive safety net of zero debt. You're essentially getting paid a 4% dividend just to wait and see if management, who, again, own a massive third of the company, can actually execute this brand transition before the revenue declines become fatal. So the question really isn't whether this stock is cheap. The math clearly proves it is. The real question is all about execution. Are you a Graham-style bargain hunter ready to buy the dip and trust the balance sheet? Or do you see a fading retail chain that completely validates Buffett's quality warning? I'll leave you to ponder that. As always, do your own homework and dig into those 10Ks yourself. This explainer is just for educational purposes, not financial advice. Thanks for joining us for this deep dive. Stay sharp and keep learning.